Imagine a world where your home's value plummeted rapidly. This happened during the Great Recession in 2007 to 2009, partly triggered by the subprime mortgage crisis. Let's explore how it began with risky subprime loans. Back then, banks were giving out loans to people who had poor credit histories or low income, which we call subprime lending. Think of someone making $30,000 a year being approved for a $500,000 home loan despite the high risk. The idea was that housing prices would continue to rise, ensuring borrowers could refinance at better rates or sell their property for profit. But this strategy didn't work out as planned. Here's how it worked. Banks bundled these high-risk loans into financial products called mortgage-backed securities, MBS, and sold them to investors globally. It was like pooling many risky bets together, hoping the overall risk would be masked or diversified away. The issue arose when housing prices began to decline, making it difficult for borrowers to make their payments. These securities lost value because they were based on loans that were increasingly unlikely to be repaid. So why did banks lend so much money to people who clearly couldn't afford it? One reason was the lucrative fees associated with each loan transaction. Every time a mortgage loan was originated, processed, and resold as part of an MBS, someone in the financial chain pocketed a fee. This model was highly profitable for banks, but became a ticking time bomb when many risky loans defaulted. The real danger came when these subprime loans were mixed with safer prime loans in MBS. Investors thought they were getting safe investments because the risky subprime loans were blended into what appeared to be a stable mix. But it was like putting bad apples in a basket of good ones. Over time, the riskier assets affected the entire portfolio negatively. Now imagine your house losing value year after year. During the Great Recession, home prices dropped by 30% or more in many areas. People who thought they were on the path to wealth found themselves underwater on their mortgages, owing more than their homes were worth. That's not a great position when you need to refinance or sell your house. But wait, there's another layer. Many subprime loans came with adjustable rate mortgages, ARMs. These start off at low interest rates, but reset to higher rates later. When the rate increases, homeowners often can't afford their payments anymore. As people started defaulting on their loans, banks foreclosed and dumped houses onto an already oversaturated market. The housing bubble burst in 2007 when home prices started falling. Initially gradual, it soon accelerated into a rapid drop. This led to the Great Recession in 2008, causing widespread unemployment and numerous foreclosures. But here's something you might not have heard. The Federal Reserve tried to prevent an economic downturn by lowering interest rates in 2001, thinking it would encourage spending and borrowing. Instead of helping, these low rates fueled more risky lending and speculation on real estate. It's like trying to stop a car with no brakes. When you need to slow down, you can't. So who ended up paying the price? You did. Your retirement savings were hit hard as stock markets declined significantly during the 2008 financial crisis. People lost jobs and saw their homes become burdens they couldn't shake off. This wasn't just about bad decisions by banks. It was a systemic failure where everyone assumed someone else would pick up the tab when things went wrong. The government intervened with bailout packages to prevent major banks from failing, but at a significant cost. Taxpayers ended up covering hundreds of billions of dollars to stabilize the financial system. Even so, not every institution was rescued. Lehman Brothers collapsed, causing widespread panic in global markets. Now let's talk about a surprising fact. The conservative option quietly outperformed the risky one every single time. Instead of chasing high-risk investments that promised big returns, sticking with low-cost index funds could have spared you from significant losses. You wouldn't have been as vulnerable to losing your home or seeing your retirement savings drastically decline overnight. But here's another myth to bust. Saving money isn't always about being frugal. It's about making informed decisions and understanding the risks involved with different financial products. So while it might seem mundane, knowing what you're investing in is crucial for safeguarding your money. The financial crisis that began in 2007 to 2008 and led to the Great Recession taught us a hard lesson about pursuing quick profits while ignoring risk. The real winners were those who maintained disciplined investment strategies, stayed focused on long-term goals, and avoided speculative investments. So next time you hear someone talk about easy gains or miracle investments, remember this: the safer path is often better for your financial well-being. The subprime mortgage crisis that sparked the Great Recession began with a seemingly simple idea, making home ownership accessible to everyone, even those with poor credit histories. Banks started offering mortgages with low initial interest rates that would rise later on. These loans were packaged into complex securities called MBS and sold off to investors worldwide. But here's where things went wrong. When housing prices began to fall, many borrowers found themselves unable to afford their higher mortgage payments after the introductory low-rate period expired. This led to an increase in foreclosures. which drove down home values even further and created a vicious cycle that severely impacted financial markets. Think about this. If you bought a house near the peak of the market in 2006 with one of these subprime loans, your initial payment might have been manageable. But as the rate reset to a higher fixed or variable rate after an introductory period, suddenly you faced significantly higher monthly payments. For many homeowners, walking away from their mortgage became the only option. This crisis wasn't just about greedy bankers and careless borrowers. It involved everyone from regulators to investors who misunderstood or overlooked the risks. The consequences were widespread. Millions of people lost their jobs, retirement savings were depleted, and confidence in financial institutions plummeted. But amidst all this turmoil, there's a lesson worth remembering. Investors who stuck with conservative strategies like index funds generally performed better than those chasing hot stocks or complex derivatives during the crisis. These simple investments provided relative stability when markets were volatile. Here's what many people don't realize. Even during market crashes like the one that occurred in 2008 to 2009, some smart choices can protect your money. If you had put your savings into a broad-based index fund rather than betting on individual companies or speculative assets, your returns might have been steadier over the long term. Sure, it wouldn't be as exciting as hitting home runs with single stocks, but your portfolio would likely remain relatively stable and continue to grow steadily through market downturns due to diversification benefits. Another key takeaway from historical events like the Great Recession is the importance of diversification. Spreading your investments across different sectors and asset classes helps reduce risk. For instance, if you had money in both real estate and bonds, one area could potentially offset losses in another during a market downturn. Behavioral finance teaches us that our brains often work against making sound financial decisions during crises. Fear can trigger panic selling, while greed might encourage risky investments. Both reactions typically result in worse outcomes for investors. So how do you stay grounded? Start by conducting thorough research and understanding what you're investing in. Know the difference between investment products like MBS and traditional savings accounts. Be wary of any opportunity that promises quick profits without clearly outlining associated risks. 1% in fees might seem small, but over decades it can significantly erode your returns through the power of compound interest. A 1% annual fee on $50,000 means $50 less each year that could have been reinvested to grow further. Over 30 years, with compounding, those missed opportunities could cost you tens of thousands of dollars due to the cumulative effect of not reinvesting the fees saved. During the Great Recession, adhering to basic investment principles such as diversification and investing in low-cost index funds could have protected many investors from significant losses. These strategies help mitigate risks associated with market downturns by spreading investments across various asset classes and reducing costs through passively managed funds. The subprime mortgage crisis was a perfect storm of bad decisions and greed that hit homeowners hard. It began in the early 2000s when banks relaxed lending standards, pushing mortgages to people who couldn't afford them. These risky loans were bundled into complex securities called MBS and collateralized debt obligations, CDOs, and sold to investors worldwide. Imagine getting a home loan without proof of income or assets. That's what many subprime borrowers did in the mid-2000s. Banks saw these as golden opportunities, offering adjustable-rate mortgages with teaser rates that seemed too good to be true. But once those low initial rates expired and reset to much higher levels after typically 2 years, mortgage payments soared, leaving homeowners unable to afford their payments and often underwater on their homes. As defaults on subprime mortgages rose, so did foreclosures. This flood of properties onto the market pushed home prices down further. Investors holding MBS that included these risky loans suffered significant losses as the properties could no longer cover the debt. This created a vicious cycle where more defaults led to more foreclosures, which in turn drove property values even lower. The collapse of Lehman Brothers in 2008 is often seen as the tipping point for the Great Recession. When this major investment bank declared bankruptcy on September 15, 2008, panic spread across financial markets. Credit froze up and lending dried out. Many businesses couldn't secure loans to pay their bills or expand, leading to widespread job losses. It's crucial to understand that not all investments are created equal. A simple savings account at a traditional bank offers stability compared to more speculative securities backed by subprime mortgages. During the financial crisis of 2007 to 2009, sticking with conservative options like bonds and low-cost index funds helped many people avoid significant losses. Remember, history repeats itself in finance. Stay vigilant about lending standards, fees, and the true risks behind investment products. This is educational and historical content, not financial advice.